here in the APAC region. My name is Frederick Nyberg. I'm the Managing Director for MedTech Innovator based here in Singapore. Joining me from the MedTech Innovator team Singapore is Glenn Lim, who's our Senior Director of Programs, and Bernice Tan, who is Head of Marketing and Events. And I'll introduce our panelists in just a second. Let me just once again welcome all of you to this second webinar in our series. We are live streaming this on YouTube, and I believe we're live streaming it on LinkedIn as well. The format is the following. We'll do our panel discussion for the first 60 minutes. We will then part ways with our YouTube audience. And for our cohort companies that have dialed in as delegates, you don't hang up at that point in time. You stay online because you get an additional 30 minutes of closed door Q&A with our panelists. So we're really excited about today's topic and thrilled to have two brilliant panelists join us. Today's topic is fundraising, term sheets, and deal structure. And joining me today is Dr. Joseph Mocano, who's managing partner at the Verge Health Tech Fund. He'll introduce himself in just a moment. Very excited to have Joseph back. I think many of you know him. We're also privileged to have Patrick O'Neill join us, his partner at MedTech Advantage Fund, dialing in from the East Coast. So thank you, Patrick, for staying up late to speak with us today. So we have a lot of interesting questions lined up, and for our cohort companies, you will recall that we asked you to complete a survey about a month ago or so, and many of these questions are based on your questions. So you'll see some of those reflected here in the discussion questions today. If there are questions, of course, that you have that we don't touch on, queue them up, let us know, and we'll get to those at the end. So let's dive in terms of just a quick opening question. If I can maybe ask Joseph and Patrick, each of you, to introduce yourselves, briefly talk about your firm, what it is that you do, maybe the stages typically that you invest in, and if you have any geographic restrictions in terms of regions that you particularly focus on. And Joseph, I'll turn to you first.
All right, thanks, Frederick. So Joseph Mocano here, co-founder and managing partner of Verge Health Tech Fund. We invest globally in impactful health tech companies at the earliest stages, and that can mean a lot of different things to different people. For us, it's literally the first check in the company to Series A-ish, if it makes a lot of sense. We invest in both medical devices that tend to be connected, lightweight, accessible to most of the population. We try to stay away from hospitals, big infrastructure, big capex. We also invest in digital platforms. So it's kind of this idea of deep tech and distribution that kind of defines our thesis of bringing healthcare earlier, more democratic and more distributed. So that's us in a nutshell. And by the way, when I do say global, I do really mean global. We have invested across 23 countries and 5 continents.
Very good, thanks, Joseph. Are you able to comment on the size of your fund and where you have the team based, perhaps as well, given that you are? I know you have a sizable European organization as well.
Well, sizable of 2 people, but yeah, thank you. So we have 5 partners on the team. So we're based in Estonia, Singapore, Taiwan, Philippines, and Hong Kong. We've got an extensive network of venture partners, advisors, other funds that we like to work with globally. That's part of how we make global work. We realize it takes a village, especially at the critical early stages. Check sizes range between 500K to 1.5 million to date. In terms of AUM, we prefer to keep that number closely guarded.
Understood.
It's not very large, it's not very small. It's enough to do what we need to do.
Very good. Very good. Thank you, Joseph, for that. Patrick.
Great. Thank you very much, Frederick. So a little bit about me. I trained as an engineer in the energy space and then moved into venture back in 15 years ago with an organization called Connecticut Innovations. That's where I found my passion for MedTech and grew a portfolio of anywhere around 14, 17 companies at any given time. And left there in 2022 and joined a team that called MedTech Advantage, and we are putting together a venture fund that will invest exclusively in graduates from MedTech Innovator. Those are 715 companies strong now. And our thesis is as a follower, not a leader. We would do up to 10% in any qualified round that comes through the MedTech Innovator program. And qualified rounds are basically standard terms that you would think of for follow-on investment. Our check size are between 200,000 and $2 million. We cap at $2 million on the first investment. We want to see at least $2 million coming in on the round, and no limitations on type of company, location, stage, etc. As long as they have went through MedTech Innovator and two meet our deal criteria.
Great. Thank you, Patrick. And I know many of our cohort companies who joined us at the MedTech Innovator Summit last month in San Francisco and Mountain View had the opportunity to meet with you, of course, in person. Quick question about the types of technologies that you find particularly interesting at the moment, whether it's in health tech, sensors, wearables, cardiovascular, orthopedics. What are the areas that interest you and your fund, and where do you see particular investment and growth opportunities? And Joseph, maybe I'll turn to you first.
Yeah, it's a tough question. I mean, we do have some hypotheses as to what could be timely at this moment in terms of, let's say, taking advantage of certain parts of the electromagnetic spectrum to look for certain clinically relevant biomarkers non-invasively. That's something we're always looking at. The multiplexing or even hyperplexing of point of care diagnostics, an area that continues to interest us as well, because you don't want to have, 20 different machines for 20 different tests. You'd really like to have one machine to rule them all, or ideally not even any machine, and it's just an onboard result or something you could click with your phone. That's kind of, again, on the kind of more deep tech side of things. I don't like devices to be too expensive, because then it doesn't really get to where it's needed. So we have to, and on that note, it shouldn't be too large, because again, if you're going to transport these in the field or in primary care, you don't want them to be too bulky. So that's on that side. On the platform side, really to play a meaningful role in the infrastructure of a health system, or to manage chronic diseases, or do remote patient monitoring, or to even act as a digital therapeutic or software as medicine. So it's really quite broad. And I guess our North Star is really disease burden maps to understand where are the significantly large clinical problems that need to be addressed, as well as what is up and coming, what is on the decline, what's being addressed today satisfactory, and what hasn't. And it's a really, really broad thesis, but it's also eerily specific, which makes it difficult for me to articulate it quickly.
Understood. No, but that's helpful background, Joseph. Thanks. And Patrick, from a U.S. perspective, where do you see particular areas of interest, maybe technology sectors or clinical sectors that are getting a lot of attention from investors in the US?
Well put, because my fund is definitely more generalist, so we don't really have a sector itself. But in the US, I think the popularity, to almost being a cliche at this point, is everything AI. So we've seen a lot of that. That's why I've been doing this for about 15 years. When I first started, it was when social networks were really taking off, and everyone was going to be the Facebook of whatever, the gamification of, and then it became the blockchain crypto of, and now it feels like everything is AI. To the point now where I think you almost have to humble brag away from AI and or really know the ins and outs and how that really changes your value proposition. Generally speaking, the strongest areas in the US tend to be in the cardiac space. And more from the market dynamics side that cardiologists, electrophysiologists, they tend to take a lot more uh, adaptive technologies earlier. The strategics in that space like to acquire earlier. And obviously they're doing PMAs and class threes.
Yeah.
And then on the other end of that spectrum is actually what I find most appealing is orthopedics. And I think I'm probably a frustrated orthopedic surgeon. Never went to med school, but definitely it's something I can really sink my teeth into from my engineering background. But very tough. It's a very tough
Yeah.
space. Typically, you need a lot of runway and run rate on the revenue side before you're going to get any interest from a strategic. So that sort of at that other end of the spectrum. And you really have to adjust your fundraising strategy to reflect that.
Yeah, understood. No, that's helpful. Thanks, Patrick. Very quickly, I just wanted to touch on the macroeconomic question here before we dive into the details. I think many of us recall 2021 as the year when healthcare funding really soared globally at the height of the pandemic, and it appears that it's sort of steadily declined since then, with valuations being down and startups are struggling to find investors. What's your take on this at the moment? Where are we? Are things starting to change? Have we hit the bottom? What's the next 1 to 2 years likely to look at from the point of view of startups looking to raise capital? And Joseph, I'll turn to you first.
All right, fair. And we can kind of bounce it around as well. So Patrick, if you disagree with anything that I say, please feel free to jump in.
Of course.
Or Frederick as well. I'm always kind of loath to talk about macro when we are in a very specialized industry. However, it is, no secret that funding has gone down across the board dramatically. But I think, especially in the digital health part of things, there was a bit of irrational exuberance thinking that, Pandora's box is being opened with this global pandemic, so everyone's going to be doing medicine remotely. We figured out how to finance it remotely as well, and then lo and behold, reality sets in as people start moving around again. So we did have a bit of a collapse. I do think that out of the ashes will rise some excellent companies that managed to hang in there. There's also it's no secret that interest rates have gone up everywhere on planet Earth pretty much. And now investors who are looking for purely financial returns have a lot more options open to them to get historical venture type returns. I mean, you have private credit, private equity, even the stock market, some government bonds even returning on a real basis what most funds have not failed to return. And then the other part is there is a frustration with venture in that DPI or distributions paid in have not been what the limited partners or the investors in venture funds have expected. So it's been really difficult when, these LPs, they see these wonderful paper gains, like, oh, the fund's up 5x. That's amazing. I 5x'd my money, but where is it? The actual money returned to investors after 10, 12 years just hasn't kept up to their expectations or what the total value paid in or TVPI of these funds are. So macro-wise, there's global macro where, okay, you have interest rates and optionality. Then you have venture macro, where you have, okay, the industry hasn't returned what we expected. And then you have, healthcare or health tech macro, where you've had this exuberance, especially in the digital health side, that hasn't really returned to what investors' expectations are. But generally speaking, I like to be a little bit of a contrarian. Sometimes contrarians are truly wrong. Let's hope this is not one of those cases, but generally speaking, when everyone runs away, maybe you should be thinking about running towards. So I do think that it is actually a really, really good time. Now, anecdotally, because we have 53 data points to look at in terms of Verge's investments and the investments that we did in our prior lives, it's getting a bit better, I would say. But we also have to be nuanced in where the bottom is. And we also have deal flow indicators as proxies as well.
Right.
So when more companies, So it's kind of like this. Companies are looking for a lot of money, before they realize that, oh, winter's coming. So some are going to be like, I'm going to sit it out because I don't want to raise during this really poor environment. And then you've got others that are like, I'm not going to, well, some shut down, and some are like, I'm not going to quit my job to start a new business right now. It's too risky. I'd like to keep my job and my income. So the confluence of those factors leads to the volume of deal flow. And the volume of deal flow we have observed are somewhat seasonal. So in 2022, US deal flow was actually really high. Then 2023, Europe deal flow became really, really high. And then during both of these years, our Asia deal flow was next to nothing. And now we're seeing US quiet down, Europe is still sustained, and Asia is picking up. And again, this is just us. This is just what comes through our pipeline. It's not indicative of what the rest of the world may be feeling.
Yeah, that's helpful, Joseph. Thanks for that, Patrick. Your perspective on this.
Yeah, as much as I'd love to start an argument with Joseph, I think I agree with everything he said. And I look at it, obviously through I'm in the U.S. and I tend to look everything through the U.S. lens. And the way I viewed it was in going back to 2020, we had think of it as dynamic systems analysis, right? You have a huge influx of liquidity into the market that created a lot of froth, tied in, as Joseph mentioned, the digital health boom in 2021. Everyone thought, finally, healthcare is gonna go digital. We're going to get into the 21st century. I'm happy or unhappy to report I was mailed paper forms the other day for an appointment with a doctor for next week. So not quite there yet. But I think a lot of tourists entered the digital health market and thinking it was going to be just like SaaS. And then they quickly retreated. So there's a little bit of that. The good news, though I see it, and this may be a little Pollyanna, is that if you look at any kind of dynamic systems analysis, it's going to come back to steady state. And I think the higher interest rates, et cetera, are going to slow things down. But I think we're going to go back towards a long-term trends. And I think 2023 was particularly brutal. We had a couple of bank failures here in the U.S., and it feels like that is behind us. And knock on wood. So I see it as yes, there's slowdown. I've noticed it in the U.S. as well. So it's not just Joseph, but at the end of the day, good companies are still getting funded, and it's always going to be hard to raise. It's a little bit harder now, but I think if you're not sure if it's still falling, you're probably at close to the bottom. And from an investor point of view, that's where I really like to be, because that's where the good companies are really taking off. You get them for good valuations, and really to be an investor in MedTech, you're a bit of a contrarian anyways, because everyone else is chasing the next tech deal, the next AI deal. And so I think I genuinely believe that it's going to be a good road ahead of us, and I'm actually really excited for it from an investor point of view. And I think from an entrepreneur point of view, if with everything the MTI teams are learning and getting that value, I think you're going to be well suited to take advantage of that the coming months and years.
Very encouraging. Thank you for that. I'm on that positive note. I wanted to dive into a bit more specifics here and also throw in a few questions that have come in from our cohort companies. And we spoke macro. I just wanted to touch briefly on the geopolitics around China. And this is a specific question from one of our cohort companies, from a couple of our cohort companies, actually. Given those geopolitical sensitivities at the moment with China, how does that affect MedTech investment in that you're looking at? And a specific question is, if I, as a startup, have Chinese investors on my cap table, is that going to be a problem for me? Is it going to be a problem in Europe? Is it going to be a problem in the US? And do I need to do something about that? And maybe, Patrick, I'll start with you first, because I think the sensitivities are probably greater in the US.
Right. And I think you're hitting those right on the head. With on the other side of it, a U.S. company trying to get investment from Chinese, you run into a lot of oversight and review. Joseph can talk a little bit more on the European side. I'm not as familiar there. But I view investments in China, Chinese-based companies, or strong ties to China. Be a little. I'm going to probably be a little bit. I just blanked on the right word here for it, but I put it in the same realm as taking investment from Russia. It's a little scary, to be blunt. Um, there's always a fear of are you in bed with the CCP? Or do you have a concern about losing your IP? And I view it with a arm's length and a lot of trepidation. I've seen different models, and maybe with offshore funding of that, if the money is offshored, is one way. But I'm I tend to I there was a time in the U.S. where going after the Chinese market, going after Chinese investors, et cetera, because it was such a large market,
Mm.
a large potential market that a lot of folks went in there, and I think their experiences were mixed,
Mm.
with that nicely. So if you're not as familiar with that terrain and how to navigate it, it's I would say tread carefully.
And if you are a company that's headquartered not in China, but let's say in Singapore or in Thailand or even in Canada, and you have a small minority investor, maybe someone holding a 10-15% stake that is based in China, that's either, let's say, a contract manufacturer or a family office or an institutional investor in China, does that create the same sort of problems?
I guess, yeah,
Um,
Patrick
I
or
think that.
myself.
Go ahead, Joe.
Yeah, Joseph, feel free to jump in here.
I think 10% is the magic number.
Okay.
When we're looking at CFIUS in the US, when we're looking at foreign direct investment regulations in Europe, it seems like 10% and this concept of control is what is concerning to the governments today.
Mm.
So if it's, let's say, 9.8%, they're a board observer but not a director, and they don't hold any major covenants on the company, that's probably okay for almost everywhere in the world.
Mm.
And what's interesting with CFIUS is that there are certain conditions, and don't ask me what CFIUS stands for. Something foreign investment in the United States, maybe the Council of Foreign Investment in the United States, or conditions of foreign investment in the United States. Maybe Patrick, you can look it up or something. There are certain sensitive sectors that are, semiconductors would be an obvious one.
Yeah, of course.
Artificial intelligence and large amount of personal data, another very sensitive one. Med devices right now are outside of the purview of CFIUS. Having just done a significant investment in a U.S. company last year, we got to kind of go through this process with lawyers, and it was deemed that we didn't need to apply.
Mm.
With foreign direct investment in Europe, we've mostly stayed under that 10% threshold in order to not invite the review, and not all countries are requiring it, which is good. I think on the question of where your investors come from, I think there are a few risks to think about. The biggest risk is sanction risk. So I would actually put, Russia in the same boat as Iran and China not in that same bucket.
Mm.
Right now, we are not sanctioning Chinese companies or Chinese individuals. That may change. All it takes is one little spark in, the Taiwan Strait or South China Sea or India, Ladakh, wherever, to perhaps change that depending on the behavior of parties. So if you want to really, really mitigate this, but this will close a lot of doors, it's, you know, friend shore your investors. So have investors that have whose governments and people have similar values and structures of how they run things and the same kind of view on what individual versus collective rights are. And not saying what's, whether it's a right or wrong answer, but if you want to play it safe, that seems to be the way to do it. And if you look at some FDI laws, they're making exemptions for certain countries. Like in the United States, if you're controlled by one of the Five Eyes, you don't go through CFIUS.
Mm.
And I suspect, and I can't verify, that the same issues in the European Union would hold true. If you're one EU state investing in another EU state, you probably don't have to go under these FDI reviews. Maybe you do. I honestly, not being an EU fund, I've not bothered to look into this.
Understood. I think that's really helpful to give us a bit of perspective on that. And we don't need to dive into that. And I think in too much detail now, because we got a number of other things we want to cover as well.
Compliance hat turning on.
I think we could do a whole separate webinar on this topic, but really appreciate your insights on that. So let's talk about investments that you make and what might be what typically makes for a really compelling investment from your perspective. Maybe refer to a deal you might have completed. What excites you about a particular investment? What are you looking for in startups that maybe in terms of traction, in terms of key milestones, and maybe if you can comment on what milestones you see really drive value in some of the companies that you're looking at. And Joseph, maybe do you want to start on that?
Sure. I think there's no one size fits all in terms of milestones and all those things. It really depends on the nature of the company, whether they're regulated or non-regulated, hardware or software, et cetera. However, there are three basic questions. Is this a great opportunity in terms of what the problem they're trying to solve is? Is it a great company? And is it a great deal? Right? So with the opportunity, is it for us, and this is just us, not necessarily what Patrick or any other investor is looking for, we want to see a problem that is both broad and deep. So are there many people suffering from this? And is it a serious issue? I mean, everyone gets itchy skin, but is that a life or death issue? Not so much. Cancer? Yeah, it is. It's top 3 killer for pretty much every country on planet Earth, including, as well as cardiovascular disease. And, another one that we haven't quite cracked, musculoskeletal pain, right? Huge issue, huge issue. Number 1 source of disability, adjusted life years in Indonesia, right? For example, not obvious, but it's there. So, is it big and serious? Or is it a systematic inefficiency that is affecting all health systems? The capture and organization of data is one really big issue. All right, so is it a big enough opportunity? Next one, is it a good company? So good company being, team, is it well run? Are they the right ones to be solving this problem with their solution, right? And then, is it a good deal? Are you as an investor reasonably expected to make 10 to 20 times your money by investing in this company? And are the conditions and governance and controls around this investment something that you're comfortable with? And again, the answer varies depending on the company, but that's kind of the framework that we look at it with.
Okay, very good. Thanks for that. And Patrick, your perspective, same question. What makes a compelling investment? What do you look for?
It's funny. I have the same three, slightly different order. For me, the first is always team, and I look for everything Joseph brought up. It's a bit of a cliche, some great teams, but it's a cliche because it's true. The one thing I will add is the grit, which is hard to measure, hard to quantify, but we all know things are going to go wrong, and it's a question of, are they going to stick with it, and when things go wrong, be able to pivot and find the right pivot. All goes to the background, their ability to or that matches what they're doing. I like to see an emotional connection to the problem that they're solving as well. I lost count, and I don't have a great percentage, but it's more than half of founders that I've dealt with on the MedTech side start the conversation along the lines of when I ask them, so what made you want to solve this particular problem? Well, my insert family member name here suffered slash died from this, and therefore I don't want anyone else's loved one to die from this.
Mm.
Okay, that's they're not walking away when things go a little sideways. They're going to be in there for the long haul, in my opinion. Um, I'd say the one thing I would add to the list though is the unit economics. I need to make sure that this is going to it can be adopted, but if you're losing money on everyone you sell, like wow, you need to have great margins. And how does that work from your COGS on a hardware side? The COGS to your average selling price, reimbursement. What are your competitors selling at now? And you'll need to discount to that, at least in the US, you'll need to discount to that price to get in. So are you going to be compelling to the hospital's value assessment committees, the VACs? So that to me is really important, and it's one of the first questions I'm asking. So, okay, let's walk through that. I really want to understand it, and tell me about the one of the first questions I ask is, tell me about the reimbursement.
Mm.
And if I get a hand wave there, that's a problem. Like, well,
Mm.
that's huge, or we'll deal with that in a few years. So you're already 2 years behind then.
Yeah, that's a good point. That's a good point. I did want to ask you as well, whether you do co-investments with strategics, with the big manufacturing multinationals, and if you see that as a positive going forward as the startup company evolves, or is it something that's potentially going to shut some doors of future investments from possibly other strategics? Is there a risk for a startup getting into a relationship like that with a strategic too early? And Patrick, maybe I'll start with you on that.
Sure. So to answer your question, we are open to and encouraged strategics to look at any company coming through the MedTech innovative side. I'll say, mixed feelings about it. I think, and it goes to the old adage, it depends, right?
Right.
There are some that are better than others. Some strategic funds are set up more as a pure financial investor. And so they're not necessarily just investing on things that are for acquisition or key to their strategic vision moving forward, just things that they like and are really interested in. On the other end of the spectrum, you have those that are just squarely investing in their product development cycle moving forward. I think it has the potential of limiting or poisoning the well for other strategics to come in. But I think you can manage a lot of that risk with terms.
Mm.
Try and keep as much of uh, the smart strategic VCs, corporate VCs, will already understand that you can't have a right of first refusal, ROFR, or right of first ask, etc. And there has to be some protection against information that may be damaging if it got from another competitor. So I think you can mitigate that risk, and I think a lot of it goes to messaging. So look,
Mm.
this is insert company name Ventures. They are the venture team. They're not the corporate development team. They're not the strategic team. So think of they're not necessarily our acquirer. They're not necessarily our dominant. But it's great to have them, and it's great to add. They add a lot of value. But no reason we wouldn't want insert second strategic name here as well. So I said, it depends. Make sure you're getting in bed with the right type of strategic.
Clear. I'm not going to ask Joseph the same question because we got a lot of questions to go through. So Joseph, if you don't mind, I'm going to go on to a different question. Because I did want to ask you about the use of a SAFE, which I believe stands for special agreement for future equity, and something that I wanted to just get your perspective on that. If that's something typically you like to see the entrepreneurs go for at the initial funding round when they're looking to collect money from friends and family, and if you see a possible role for a SAFE at a later stage of financing as well.
Yeah, I don't like them, but that's a very personal decision. I don't think they're very safe at all. And I find that a lot of founders end up breaking their cap table inadvertently because they kind of raise safes indefinitely. They keep kicking the can down the road. And some investors who write safes don't know the difference between a valuation cap and a valuation, and that's actually proved to be an impediment in some deals. We actually had to walk away from one because of such a situation.
Interesting. Yeah.
It was unfixable. So generally speaking, I think it's good to use them in measured doses. So if you have unprofessional investors who don't want to misprice your company, I think it's good to do a SAFE at that first round. SAFEs are also useful in between rounds where you really don't know where you stand. You're between milestones that would create a valuation inflection point in the company. Yep. Again, use them sparingly. But as a primary tool of fundraising for the first several stages of the company, super bad idea. I think the moment you have a professional investor on board, it behooves them to set a price and make this a proper company. Because you got situations now where companies are 4 or 5 years old. All they've ever done is SAFEs. There's no board. There's no shareholder rights. There's none of this stuff. And you get an investor coming in that expects the company to be at a certain stage of corporate governance maturity that just isn't there, and it becomes an irreconcilable difference because the founder's now set in their ways after 4 years of running their company in a sort of laissez-faire sort of way. Again, this is not always the case. Now, safes were really popular during the bubble because it takes you all of 10 seconds to issue one and sign it and send the money. And if you're in a very competitive deal and there's all this free money sloshing around, yeah, it's a great instrument. But things are coming to a bit of a reckoning right now, and so again, I'm really not a fan of these instruments.
That's helpful feedback. Thanks for that. And related to things that you may not be a big fan of, what are some of the red flags that you come across when you interact with companies as you do that first evaluation, you listen to maybe their first pitch? Are there some specific red flags that will make you immediately walk away from that opportunity? And Joseph, maybe I'll start with you on that.
We're the only ones in the world doing this. That's usually what
I have no competitors. Yeah.
Yeah, I have no competitors. That's even better. It's like I have no competitors, because you can be the first one in the world doing something. More times than not, they're not. Right. They just haven't looked around hard enough.
Yeah.
That being said, we have invested in ones where we really do believe they're the only ones or the first ones in the world doing something. That's number one. Founders don't listen. You can be stubborn, but after you listen, right? But if you don't even want to listen, then healthcare is bloody hard. It's too hard for one person to figure it out. I literally think if you were to have an incoming hypothesis and don't listen, you'd probably succeed maybe 1 out of 100,000 times, given the complexity of the environment.
Yeah, good point. Patrick, your thoughts on red flags?
Yeah, so I have a couple of catchphrases that I heard many times. Build it if their sales strategy is build it and they will come. That usually that's usually pens down right there. And not listening is higher on my list, but as well as reacts negatively to feedback. It's like if I'm already arguing with you on your first presentation, I could be wrong. I might be wrong, but if you're rubbing me the wrong way, you're probably gonna be rubbing other people the wrong way. That was one of the first lessons I learned as an investor. I may think I'm relatively unique, but when someone gets on my nerves. They're probably going to get on a lot of people's nerves. So it's going to be really tough, not only to find other co-investors, but to find people to come work for you, to be your customers, to be your vendors, etc. And I tend to focus in on the unit economics a lot. And if I feel like they haven't done their homework on that, that they don't understand those basics of how much this is going to cost, what it needs to cost, and what's out there in the market today. And that's a major red flag. And if they haven't thought through the FDA reimbursement, even if they're not, even they may not have the answer, but at least know what it would need to be. I can't be I don't want to be the one who knows more about this than they do when walking in there. I want that to be school's in for me at that point. That I'm taking notes. I'm learning about this problem, about the reimbursement, and I feel like they've really done it and have this. Not have all the answers the way it's going to be, but at least know the pathway to get to those answers are my big ones.
Very helpful. Thank you for that. Now we have about 20 minutes left or so. I did want to talk about term sheets and deal structuring. So, and maybe Joseph, I'll turn to you first on this. What would be maybe some of the top 2 or 3 critical items in a term sheet that may not be necessarily obvious, but that could have major ramifications for a startup at a later point? What should a startup watch out for in a term sheet? Things that are easy to overlook, perhaps.
So things that are there as opposed to missing.
Correct.
So, I think there's some gotchas that maybe are, Patrick even alluded to earlier, right of first refusal, right of first offer. Those are definitely gotchas, because they can drag things on quite long, and they tend to be a little bit subjective in their interpretation, which is a little bit dangerous. Any liquidation preference multiple that is not 1, that is something, they sneak up on you, because the moment it's not 1, it means the investor after you also can say it's not 1. And that number never goes down. So the best you can ever hope for is that number stays the same, but it's highly unlikely that it will stay the same. So that's so even if it's like 1.1 or 1.2, that shows a precedent, because the next one might be 1.4, and pretty soon you're at a 4x liquidation stack. You sell your company for $1 billion and you get 0. And this has happened. I know people where the exit is phenomenal, like $750 million, which is 5 times the median exit for a MedTech company in the United States. And the founder walks away with 0. And if they're lucky, they get a little bit of an earnout from the acquiring company to kind of incentivize them to stick around. So watch out for lick prefs. I think any blockers, you have to be careful with your reserve matters. And if you don't have a deadlock clause and how to resolve board deadlocks, or shareholder deadlocks, that's an issue. Now, I would actually say, Frederick, that the greater danger of term sheets is having a term sheet that's too simple and leaving a lot of these critical clauses to the definitive agreements. Then you're, 2 months into this process, you're running out of money. The investor throws a bunch of things that you didn't talk about that they say is market standard, that, come and blindside you. And then, you're dwindling on reserves. You turn down all the other investors because you're deep in this. You have exclusive negotiations. So try to get the term sheet as detailed as possible, because you could make a legal argument of bad faith if they deviate from the term sheet from definitive agreements.
That's a great point. That's an excellent point. Good takeaway there for the companies on the call. Patrick, anything you'd like to add to that at all?
Sure. For me on the investor side, I think look at, especially on convertible notes, what happens around maturity, before or after maturity, what drives automatic conversion, etc. That was one thing I would always look at as a as an investor, and obviously you want to be as diligent on that as well. Um, Also, the preemptive rights. What does the shareholder rights have what do you have to get that shareholder vote for, and what percent of shareholder votes? Percentages there tend to matter. If you have a lead investor that's taken a big piece of that, can they block, or can they be overruled by the rest of the investors if it gets to a nasty position? Those are things I also would look for. Properly constituted drag along rights, co-sale rights, to make sure that one disgruntled investor or one investor doesn't, especially if you have a lot of smaller, that they can't hold up a great deal. And so you want to make sure that it's best to have as few classes of securities as possible, in my opinion. And by the way, this all is gearing going towards legal advice, etc. I'm not an attorney, and although I've talked with many great ones, and but you want, in my opinion, you want to keep as few classes as possible. If you're taking notes from many people, etc., try and keep them in the same class so they're all acting together, and you're not having to chase many individuals to get their approval, and help stop some of that blocking that Joe mentioned. And I think that was we talked a little bit about the preemptive rights. Those you can get into the weeds there, and I really like Joseph's advice about a very detailed term sheets, and mainly because you're negotiating that one-on-one in plain simple language, and that's a lot cheaper than having your attorney and their attorney bounce that around for an hour at pick your several $100s an hour rate times two or
inflation,
three, or
man.
how many are you talking about it? Yeah.
So,
Yeah.
That's a good point.
Brutal.
That's a great. Excellent
maybe,
advice.
maybe one
Yeah,
really
go
quick
ahead. Go ahead, Joseph. Of course.
One really quick one. I'm starting to see, and I kind of like, but I don't see it enough. Angel-friendly terms where your tag-alongs don't really trigger until it's above like 1 or 2% of the securities that are offering. So this is offering your angels to kind of buy and sell, of course, with the insurance that there's no hostile actor or competitor coming on board.
Right.
But the idea that any transaction beneath a certain percentage is exempt of these clauses. So it's an opportunity for buyouts of angels and early investors or minority investors to happen more easily and without friction, or with less friction. I'm starting to like these clauses being on both sides of the table.
Good. Very, very helpful. Very helpful. Quick question from one of our cohort companies here about bridge rounds. Any particular recommendations on how to structure a bridge round? Anything to watch out for the point of view of the startups? And Joseph, maybe I'll start with you on that.
There's as many bridge rounds as there are companies, and actually there's more bridge rounds than companies. I think it really depends. Are you coming from a position of strength or not? And is the bridge being provided by your internal investors or your external investors? And I think it's just it depends. Generally speaking, the rounds I'm seeing are party rounds, and they're largely in the form of just rolling convertibles or safes. That's just what it is, because if it's a formal round, it's not a bridge round.
Yeah. Okay, no, that's good. I did want to touch on briefly on valuation as well. A common question that we get is whether you like to see a startup come to you with a proposed valuation or valuation expectations, or if that's something that the startup should better avoid and leave that to you as the institutional investor to propose. What are some of the considerations there from your perspective as an investor? Patrick, maybe I'll turn to you first on that.
Sure. So the old adage that in negotiating, the he who speaks first loses. I don't hold
Yeah,
strongly to that. There is some logic there. But I from an investor point of view, I think if you're coming in and you're saying, look, here's my expectation and here's why, is more important. And I think it goes towards, keep in mind that your lead invest when you talk about this with your lead investor, he or she is going to be on your board, and is going to be need to be a trusted advisor. And this is a good one of the first good tests. Like, okay, how am I going to be able to speak with this person? And is she going to be the type of person? Oh, you think it's going to be 25? Okay, well, it'll never be higher than that. And so, all right, as opposed to, well, why do you think that? Let's consider that, and it's a good point. And move through the discussion rather than try and squeeze that last 1%, 0.5% of ownership out of the founder. I think for me, I use them as a um, sort of not a team building exercise, but an analysis tool to see how is this person going to negotiate? Because how they negotiate with me is how they're
mm,
going to negotiate with everybody else.
true.
And if we go 3 weeks and I can't get a number out of them and say, well, I think it should be this. Oh, well, it could be. And this is getting tiring. Um, so I think having that research, having that knowledge, and being able to defend something reasonably, other than, this is the market, or like, look, this is what I have to raise, and if it's much lower than this number, I'm going to be 1% on this company by the time we get to Series B or Series C, and that's not a founder, that's an employee. That To me, that's a compelling case, because I
Mm,
don't want to make my founder an employee. I
mm,
want nothing wrong with employees, but they're not as vested, you know, pun intended, as someone who owns 15-20% is
mm.
going to put a lot more sweat equity in here and go that extra 10 miles that's needed.
Great point. Joseph, your thoughts on that valuation negotiations?
Again, it's a question of not so much who goes first, but the strength of the argument.
Yeah,
Yes, there's a lot of negotiation theory around, anchoring and, midpoints and all this sort of stuff, which I've long forgotten from business school, but certainly more of an art than a science, in my opinion. But if you as a startup are giving me a valuation and you can't defend it, you can't tell me why. Like, the first question I ask is, I don't say it's, too expensive or not expensive enough unless it's egregious and really, really far away. And that has the risk of ending a discussion right
mm,
away. If
mm,
it's really just, several standard deviations away from what you think the right answer is.
sure.
But, I'm always asking, like, what brought you to that number?
Mm,
And I want to see the strength of their assumptions. Generally, I like them offering the number first because it gives me an opportunity, like Patrick, to understand their thought process and,
mm.
how rigorous their analysis is of what they think their company's worth is and their own worth relative to that company, going to that employee versus founder sort of question. I do ultimately think it's the job of the investor to set the price.
Mm.
Now, whether that price is markedly different from the price the founder wants, I mean, that's the discussion.
Yeah.
And if founder says, "Look, that's your job," all right, well put. It's our job. We'll do it. So, but I do generally like to give the founder the option to say, "Here, we'll set a price, or it's your job."
Yeah, yeah. And that great point about wanting to see the founders negotiate and the approach they take to the thought process that's gone into setting that valuation. So that's really helpful. We're almost coming up to the hour. I wanted to just a quick question related to what Patrick was talking about earlier in terms of founders and founder shares. Typically, what do VCs expect in terms of percentage ownership by the founders, operationally involved founders, CEOs? to demonstrate that continued engagement and for it to be enough incentive for them to want to really drive the business forward. Is there a magic number in terms of percent ownership that you'd like to see? Joseph, maybe first.
I wouldn't say there's a magic number. There's probably a magic range.
Mm.
And the factor, I guess the factor of this number varies by which the stage of the company is and the capital requirements of what needed to get them to where they are.
Yeah, of course.
I think over dilution at an early stage in a non-capital efficient company is certainly a broken cap table. If they were capital efficient and if they did everything right, and that's where they ended up because it costs a lot of money to get to where they need to do, and they didn't want to run around fundraising, I can understand and respect that. I think every cap table has a story. But ultimately, if you're going to look at it as an employee versus founder or purely numerical question, it's what is the opportunity cost of me not doing something else? And if that number is greatly different than what your expected value of your shares are, then I would be worried, and that is a broken cap table. Now, for example, let's take this at an absurd example: fusion. Nuclear fusion is going to cost billions, if not trillions, to come to market, and just to get to your proof of concept is going to take hundreds of millions of dollars, right? Do you, as a founder, expect to own 75% of that company when it requires that much money to get there? No, absolutely not. So as a founder, you would be lucky after getting a lot of that money to own, 20% or 10%. And now you're working on fusion.
Right.
And if it works, you're going to be a billionaire. And yes, your shares of your company have you in such a point where, okay, you're an employee, basically. You're an early employee's founder stake, share stake. Sorry, I'm not being clear enough. Yet the opportunity is amazing. It's like, what else can you do? And there are mechanisms by which you can still not have ownership but have control, because let's not conflate equity ownership and control over the company's fate. And there are ways to play around with that, especially in these kind of more outlier situations. Now, if you're coming into your seed round and own 35% of your company and you're making a widget, no, that's not good enough. And sometimes these are forgivable, and you can fix the cap table by creating a massive MSOP or management stock option pool plus ESOP in order to rebalance the cap table, get rid of some of the dead weight. But your investors are not going to necessarily like that very much. And you have to make sure that your investors are on board. And this is where, who you have on your cap table is really, really important as well. And I think that's something that's not talked about enough. Yeah. Investor risk is one of the top 3 risks, I think, in any startup.
That's a great point, Joseph. Thanks for that. And just quickly from Patrick, when does same question essentially? When does a founder become an employee? At what sort of shareholding percentage do you see that happening? What would you like to see the shareholding of the founder have?
I can't give you I'm going to defer to Joseph on this. I thought that was an excellent answer. It depends. I think we should take note of how many times we've said that phrase. But it really depends on the company itself and that opportunity cost. That's a really great way of looking at it. If this is going to be a $10 billion company and you're owning 1%, that's still pretty, that's better than going to work at as an employee somewhere, because you have the possibility of making.
Yeah. Well, look at it this way, Patrick. The more we say it depends. Sorry.
No, go ahead.
No, sorry. I think we lagged, or one of us lagged. But I'll just say, look at the bright side. The more we say it depends, the less likely an LLM will replace us.
That's probably true.
I like that.
Gentlemen, time's up, I'm afraid. I wanted to before we close and disconnect with our live stream audience, final word of advice from each of you. advice to MedTech founders, MedTech CEOs that are in the midst of fundraising and perhaps struggling a bit along the way, and times are tough, but it's good to hear earlier that things are looking up going forward. Final words of advice from you, Patrick, perhaps first.
Sure. So word of advice is it is very hard. And just because and I'll give the advice I'd give to teenagers on Instagram. What you're seeing on LinkedIn, what you're seeing, all these success stories, don't let that get you down, that you're not getting there. It's incredibly difficult to raise. And I would be as diligent in reviewing your investor as they are in reviewing you. You're going to be hand in hand with them for years. It's not always going to be pleasant. Everything's not going to go to plan. And how they react, same thing that I was saying about founders. How they react under stress, how they react when things don't go right is just as important as how you react, because it's a team sport, and you want to make sure you have people on your team that can do their job, but also help you do yours.
Great. Thank you for that. Joseph.
I'll give a bit of advice on advice, which is always question the motivations and experience when receiving advice from somebody. And like all good science, triangulate. You can't triangulate a single point.
That makes a lot of sense. Excellent advice from both of you. Great insights. Thank you, Patrick, and thank you, Joseph. We could have gone on here for at least another hour easily on some of these topics, and we didn't get to cover them all. So thank you both. Don't go away. We're going into Q&A in just a moment. But at this point, I wanted to thank our live audience on YouTube and LinkedIn for joining us. We obviously, our cohort companies, please